From the moment we open our first bank account, we're taught to chase a specific three-digit number. We're told an 800 is the ultimate sign of financial maturity. But that number doesn't measure how responsible you are with your own money. It measures how profitable you are to lenders. This conditioning starts early. Parents add their teenagers as authorized users, hoping to give them a head start on what feels like an objective grading system. We treat it like a moral report card, a pure reflection of hard work and self-control. The entities handing out these grades aren't government agencies or objective tribunals. They are massive private data brokers, primarily Equifax, Experian, and TransUnion. They are the centralized architects of a vast behavioral tracking network. A high score doesn't mean you have a robust savings account or massive wealth. It means your borrowing patterns perfectly match an algorithm engineered to predict how reliably you generate interest payments for the financial sector. To understand the credit industry, you have to look at who is actually writing the checks. Banks and lenders pay the bureaus for access to their databases. In this transaction, the bank is the customer, and your life history is the raw material. The entire architecture of credit reporting was constructed to mitigate risk for creditors. It gathers millions of personal records to ensure that lenders know exactly who they are dealing with before they issue a line of credit. There is no opt-in button. The moment you interact with the modern financial system, your data is vacuumed up. You are entered into these corporate databases involuntarily, often from the moment a childhood account is opened in your name. Every loan application, every late payment, and credit inquiry is aggregated and packaged. The bureaus then turn a massive profit by selling these detailed dossiers back to banks, insurance companies, and marketing firms. Because you are the commodity being traded, the priorities of the credit bureaus do not align with your economic stability. Their priority is the precise categorization of your financial behavior, regardless of how that categorization affects your life. The dominant force evaluating that behavior is the FICO algorithm. It functions as a proprietary black box, its exact mathematical formulas guarded as corporate secrets. But we do know its central paradox. To prove you can handle debt, you must continuously incur debt. This chart shows how the algorithm weights variables. Pay off a loan or close an unused card, and your length of credit history shrinks, your score drops. The math penalizes independence. Live within your means, and your credit erodes, while maintaining revolving debt is rewarded. This creates a dangerous loop for the financially vulnerable. The standard advice to build credit is to open a new line of credit and carry a small balance. For someone already struggling, taking on high-interest subprime debt just to satisfy an algorithm invites instability. The calculation isn't designed to help you reach a point where you no longer need banks. It is calibrated to keep you on a profitable treadmill, steadily borrowing and repaying, generating fees and interest in a continuous cycle. To bring the millions of unbanked people onto this treadmill, the industry has turned to what it calls alternative data. Fintech companies are feeding non-financial variables into their risk models. They are scraping social media activity, analyzing college transcripts, and even tracking the exact time of day you submit a loan application. An application submitted late at night or from a specific zip code can be flagged as higher risk. But these alternative data points highly correlate with race, class, and neighborhood demographics shaped by decades of segregation. Replacing financial data with lifestyle proxies does not bypass systemic bias. It repackages historical redlining, laundering the prejudices of the past into the automated algorithmic decisions of the present. The impact of these algorithmic decisions has spilled far beyond the teller window. The credit system now deeply influences the labor market, with companies regularly running credit checks to screen job applicants. This plot shows a sharp decline in job vacancies when employers screen credit. When an individual suffers a sudden loss of income, their ability to pay debt vanishes. As they fall behind, their score plummets into these lower confidence intervals, where job opportunities vanish. Prospective employers then pull that damaged credit report and use it as a reason to deny the applicant a new job. The worker is kept unemployed specifically because they ran out of money, preventing them from earning the paycheck required to repair their score. The credit score becomes a self-fulfilling prophecy. An individual without a job cannot get credit, and without credit, they cannot get a job. engineering a persistent underclass effectively locked out of economic recovery. If this system routinely traps workers and relies on opaque algorithms, why haven't federal regulators forced an overhaul? The consumer data industry spends millions of dollars annually lobbying the government. They dedicate enormous resources to shaping legislation and weakening consumer protection laws before they even reach the floor. Recently, this influence has targeted federal oversight directly. The major credit bureaus have pressured the Consumer Financial Protection Bureau to stop publishing data related to individual consumer complaints, effectively asking the government to hide millions of documented errors from the public. At the same time, deregulation efforts have severely weakened the Bureau's enforcement capabilities. The agency has reduced its examiner staff drastically, eliminated in-person inspections for virtual checks, and even asked its remaining regulators to take a pledge of collaboration with the very institutions they are supposed to police. The credit bureaus have successfully insulated their black boxes from the government. They have engineered an oversight environment that prioritizes corporate secrecy and smooth operations over the accuracy of the data dictating millions of lives. The credit score has evolved into something far more pervasive than a simple risk assessment for banks. Today, this three-digit number functions as a privately owned, unregulated public utility. This single metric now acts as a gatekeeper for essential life services. It determines your ability to secure an apartment, dictates your auto insurance premiums, controls your employment prospects, decides your options for emergency survival. Despite holding this immense societal power, the system offers no exit. You cannot take your data elsewhere. You cannot opt out of being scored. Knowing this, we have to stop treating an 800 credit score as a definitive measure of personal responsibility. Your moral and financial self-worth is not reflected by a three-digit number optimized to maximize bank profits. Consumers have to navigate this system carefully to survive, paying the bills and playing the game. But as you make your moves, remember that the board was designed by lenders. The rules are hidden, and the house is always set up to win.